Hi, everyone, and a very warm welcome. As investors, we often have this question as to why our returns in the portfolio are different from the returns that the asset class has generated. A lot of it can be attributed to the behavioral gap or dynamics of behavioral finance. To discuss some of the concepts of emotional and cognitive biases, we have with us Mr. Ajay Tyagi. He is the Executive Vice President and a Senior Fund Manager with UTI Mutual Fund. He is a CFA charter holder from the CFA Institute US and has over 2 decades of experience in the field of financial services. He manages domestic equities and is also an investment advisor to India dedicated offshore funds. Thank you, sir, for joining in and a very warm welcome. I hope you, your family, and everyone at UTI Mutual Fund are doing well. So my first question to you would be that, it's a well-known fact that all our knowledge is about the past and all our decisions are about the future. And also most of the errors that we commit are not from analytical skills, but from errors in psychology. So as a money manager who manages more than 15,000 crores of equity assets, what is it that you do to stay rational in the most turbulent market scenario?
First of all, thanks for getting me here, and I do sincerely hope that you and all your investors are staying safe. You're very right. I think the tallest investors over the last many decades, and in fact, I can say going back to about a century, have always told us this, that investing is about keeping your emotional quotient right rather than focusing on your IQ or your intelligence quotient. It's a business where you really don't need too much of brains to be very successful, but you have to be emotionally very, very stable. And I guess the events of the last 3 months would have literally knocked the wind out of many investors, and they would have literally made many investors think about what truly investing is. How do we reach out to our long-term goals? How do we consider this ensuing pandemic in terms of what we are supposed to do, what are the actions we need to take, and so on. Let me very quickly start with this gentleman called Benjamin Graham. Not many would have known about him. So therefore, for starters, let me tell you that he was one of the early fundamental investors that the world has seen, going all the way back to the 1930s and 40s. He was also the guru of Warren Buffett, and I'm sure everybody knows about Warren Buffett. The only time when Warren Buffett came out of Omaha all the way to New York was to basically be a student of Benjamin Graham. And after completing his MBA and learning courses in investments by Benjamin Graham, he worked with him for a couple of years and then went back to Omaha. Benjamin Graham, way back in the 1940s, had basically conceived a character who he called Mr. Market. And he has mentioned about Mr. Market in various books that he has written. And he would say that, look, a typical investor is an investor who is not emotionally stable, who keeps vacillating between bouts of extreme pessimism and bouts of extreme optimism. He will come out one day and he'll be extremely negative about stock prices, and he would be ready to dump all of his stocks at a ridiculous price. On certain other days, he would come out and think that trees will grow onto the skies, and he would want to buy everything at atrocious prices. And this is a behavior which is basically typical of most participants in the market. And that is why Benjamin Graham, instead of calling a particular character as Mr. Market, he says that the overall markets per se exemplify this behavior, and therefore he just called everything as Mr. Market. And he said that way back in 1940s that, look, you're supposed to take advantage of the mood swings of Mr. Market. Don't get unnerved by what the markets are offering to you, but always try and take advantage of that. Don't get influenced by them. Take an advantage of Mr. Market. And I guess his words were extremely, extremely prophetic. I would say that almost 80 years down the line, I would see the same behavior play out time and time again. I've been in the markets for 20 years, and I can tell you that I see this behavior in every other crisis on one end and every other bull run on the other end. And I guess this is the reply to your question, which is that you have to be emotionally very, very balanced. You have to think many, many years out. You're not supposed to have a focus on the here and now factors. You have to, in fact, zoom out of what's happening in the short term. You have to zoom out of the here and now factors and, quite frankly, zoom into the longer term issues that matter. The structural issues of any business are the ones which will decide whether the business is worth or not, whether the business will create value or not. I'll have to get a bit technical in my remarks now, and it is very, very important. And I do hope that while keeping it simple, I would still be able to drive home the point. You see, in the most fundamental sense, the value of a business is nothing but value of discounted cash flows. Every business creates profits and also creates cash flows. But you see, we're more interested in the cash flows of the business and not profits. It's a very common saying in the business parlance that top line is vanity, bottom line of profits is sanity, but quite frankly, cash in bank is the reality. And therefore, we have to index and benchmark and reference ourselves time and time again to this reality, which is cash flows. And that's how the value of a business is determined. You figure out what are the cash flows that the business will generate each year 1, 2, 5, 10, 15, 20, and so on. Discount them back to today, and that gives you the intrinsic value of a business. That you then compare to the price at which it is quoting in the stock markets and realize, can I create value for myself by purchasing this business at price X when I know that the intrinsic value is possibly 1.5x? But the beauty doesn't stop here. Great businesses which keep persisting because of great entrepreneurs and great management, they keep doing well year after year, they keep surprising us, and therefore this intrinsic value keeps increasing year after year. And therefore, while you would have purchased it in the first instance at $100, thinking that the value of the business is 150, but because the intrinsic value keeps increasing on account of the efforts of the management, this value also keeps increasing. And that's how buy and hold investors are rewarded in the fullness of time. The point I was trying to make here is now, having this equation in front of us now, is that, you see, we can break up the value of a business into two distinct parts. One is the near term. And for me, near term is not 1 or 2 years. For me, near term is, let's say, the first 10 years. And then beyond 10 years. Every business is a going concern. You've made these efforts to bring up your own investment partnership and business, not because you want to keep it alive for 10 years. You hopefully want to keep it alive for the next 20, 30 years or even more. Same is the case with Nestle, same is the case with Maruti, same is the case with an HDFC bank. These are going concerns. They're built to last hopefully for 30, 50 years, even more. Let's call the value beyond 10 years as what we call as perpetual value. Difficult for you and me to forecast what will happen in the 11th year for even a very predictable business like HDFC Bank. So let's call it perpetuity value. I won't go into the basics of how perpetuity value is calculated. It's mathematical, but let's ascribe a value to it. Our own analysis across industries tells us that perpetuity value varies between 25 to 50% for various businesses. Let's take the midpoint. Let's take it as 35%. So for any typical business you can think of, the value of that business coming from the 10th year and beyond is 35% of its overall value, which leaves 65% value coming from the first 10 years. Let's make an assumption again, and it's a simple assumption just to drive home the point, that every year this business makes cash flows of 100 rupees, and these cash flows are not growing. A very simplistic assumption in order to just make the mathematical calculation and the framework very easy. Every year the business generates 100 rupees, year 1, year 2, year 3, all the way up to year 10. Now the pandemic hits economies globally. It hits India as well. There are shutdowns, while shutdowns have started to being rolled off, but there is damage to the businesses. Normalcy will take 2 years to return. Let's take a conservative assumption. Because of this lockdown and because of the pandemic persisting, businesses will be impacted to the extent of 50%. profits and therefore cash flows of businesses come down by 50%. So what was estimated to be 100 rupees of cash flows in year one will only be 50 rupees. What was assumed to be 100 rupees of cash flows in year two would be 50 rupees. But the pandemic goes off from year three, and from year three, we again come back to 100 rupees of cash flows. If you do the simple math, then what had led to a value of 1,000 rupees in a pre-COVID scenario, 100 rupees each year for the next 10 years, gets drawn down to only 900 rupees. 50 rupees each in the first 2 years, from the second year till the 10th year, again 100 rupees. So that's the total value of all of these cash flows over 10 years is 900 post-COVID, 100 pre-COVID. A loss of just 10% in value. But it's not 10%, because remember, 35% is residing into perpetuity, which is not hit. You can't assume that a pandemic today would lead to business outcomes remaining very different even after 10 years. That's not going to happen. That hasn't happened in any of the previous economic crises, won't happen even today. All we are saying is that because of this severe pandemic, which reduces the profitability of businesses to one half, that's a very serious assumption we are making, will also lead to a loss in value only to the extent of 6 to 7%. And I can assure you that there is no mathematical jugglery that I've done. For the more thoughtful investor, you can build different scenarios, build in that even in the third year, profits will be down 50% and will come back only in the fourth year. Build any scenario, you would realize intrinsic value never moves beyond 10, 12% in the worst case. That is actually the reality and the picture that an emotionally stable investor who doesn't want to get influenced by the economic downturns and therefore bouts of pessimism should keep in front of his mind. Prices are down 20, 30%, in some cases even more, whereas the underlying economic value is down at best 10, 12%. If you keep this equation in mind, you will always be an emotionally stable investor, ready to take advantage of Mr. Market rather than getting influenced by Mr. Market. So a long answer, but I thought this framework is very important for all of us to appreciate.
So, sir, I think you made a very interesting remark about the difference in price and value. And something that we've often seen is while we start the investment process for an investor, we determine his risk-taking ability from two perspectives. One is his ability, and the second is his willingness. Now, for the set of investors that I'm generally talking about, by and large, the ability would have not changed significantly, so to say. But however, we believe, and it comes out in various discussions that we have with them, is that the willingness to take risk has suddenly decreased, right? And or it could also be a situation wherein they overestimated their willingness to take risk previously, and they're underestimating their willingness to take risk today. So, how would you advise an investor to maintain a balance between his ability and willingness, in the given situation that we are in?
Yeah, that's a great question, Megha. And let me draw an analogy to the previous answer that I had. So think about basically the ability to take risk as the more stable factor akin to the value of a business. And think about the willingness to take risk as the price of a particular business, the one which keeps moving one way or the other, and the one which is much more volatile. So you see, the ability of a business of any individual is fairly stable. It cannot change from month to month or year to year. It is driven by factors like what are the kind of cash flows that that person generates. He could be a salaried employee, he could be an entrepreneur, or he could be a proprietor of a very stable business. So we all know what those cash flows would be over the next 2, 3, 4 years. We also know what would be the requirement of those cash flows 5 years out, 10 years out, for our child's education, for our child's marriage, if you want to move into a bigger house after 5 years, and so on. So the ability to take risk is driven by the sources of cash and the requirement of cash. And any good advisor like you, I'm sure, already knows these things and therefore works out an asset allocation plan for the client. The big challenge which any investment advisor like you, or for that matter, a fund manager like me, faces is when the willingness to take risk, starts to dither. and it differs typically along with the changing sentiments of the market. Some people back in January, February would have been very excited about the prospects of the Indian economy, could be sitting with you and discussing about how to increase their SIP amounts from 50,000 per month to maybe 70,000 per month. And then starting March, I'm showing the conversations would have changed to, do I persist with my SIP? Do I stop them? Do I decrease them? So you see, the willingness to take risk is the one that every investor has to realize cannot actually be so volatile. It cannot get influenced by Mr. Market. The willingness has to be a very, very, I would say, a congruous variable to your ability. It should not, it should move along with your ability. So if your business starts to do well, only in such circumstances should conversations about, look, I'm getting more cash flows in now. Can I increase the SIP amounts? So I think that's the part which all investors have to take care. Of course, they have to be hand-holded by financial advisors like you, and that's where your role becomes very, very important.
So, sir, inherently, you made a point about discipline. But just to draw an analogy, for example, someone has a temperature and goes and sees a doctor. After 5 days of medication which is prescribed, in about 3 days, you would probably stop taking the medicine. And in case there is even a slight relapse, you would either blame the doctor or you would blame the medicine. And you would kind of probably be very influenced with what is happening in the short term, and that's exactly what happens as far as investments are also concerned. We forget that the short term phenomenon are driven by psychological actions, and the long term trends of the market do not necessarily change. So how would you kind of advise investors to stay disciplined as far as their investment journeys are concerned?
See, unfortunately, the human mind is not trained to think about the long term. It's always influenced by near term moves. Uh, One of the important things that yoga teaches you and me is have a very stable mind. You know, things will happen at their own pace. You don't have control over them. Think about the long term. Think that uh, there is calm in the entire universe, and there is things are happening that the way they are destined to happen. Likewise, in investments, you again have to realize that you can't control the short-term variables. And if you can't control either these short-term variables or these exogenous variables, then what is the point in getting moved by them every now and then? Train your mind to think about the long term. Let's go back to the history of common stock investing. How did common stock investing start a couple of centuries back? Common stock investing was nothing but becoming part owners in businesses. People thought that if they have to grow their businesses as a sole proprietor, they don't have enough capital to do so. So therefore, they can invite 5 or 10 or 20 different people who also partake in this enterprise. They will come in with capital, and with the combined pool of capital, they would be able to grow the business. That's how common stock investing started, which has taken a very, very different meaning today, because people think that, stock prices can move up suddenly. Let's take advantage of that. If a near-term event like a pandemic hits, stock price are only bound to crash. Let's exit out of that. And all of this behavior then starts coming into the equation. But if you are investing into securities, you again have to think as if you are an entrepreneur. What's the difference between, let's say, being a part owner of HDFC Bank, let's say, that you and I are, and being the majority holder of HDFC Bank? By the way, there is no majority holder in HDFC Bank today. It was started by HDFC Limited 25 years back, and they are the single largest holder, but they're not more than 50%. They may be about 21, 22%. And there are many investors who are 3, 4, 5%. So you see, all of us have to think like we are part owners of HDFC Bank. We have to look at factors which will influence the business of HDFC Bank over the next 3, 5, 10 years, rather than looking at where the stock price of HDFC Bank would be. That is the entire reason, therefore, for common stock investing. We are all part owners. there would be many of your clients who would be entrepreneurs, who would have established businesses 2, 5, 10 years back, who would be reaping the fruits of their hard work today. I'm sure they never think of selling out their business just because a pandemic has broken down. If their businesses were listed, the stock price of their businesses could have been down 30, 40%. I'm sure that wouldn't have been a trigger for them to sell out of their businesses just because the market is valuing their businesses down 30, 40%. And if that's the case, then why should I, as a minority shareholder of an HDFC Bank or a Maruti, think to sell out of my business when it is down 30, 40%? Why am I not looking at how many more cars can Maruti sell every year over the next 3, 5, 10, 15 years? Think like the owner of Maruti, which is exactly what I want all common stock investors to think like. A, as a portfolio manager who's running money, of course, but also the investors who are investing their money into my fund. I want them to all think like long-term owners of businesses. And once you start thinking on those lines, then you basically start realizing that, look, these short-term variables should not even come into the framework. They are volatile, but they are exogenous. I don't have any control over them. Let me just keep thinking about the business. If there is some problem that you feel the business will face in the next 3 to 5 years, that the business structurally is getting damaged, that is the only reason when you have to sell out of that business and put your capital into some other business. So I think that's how all of us have to tune our minds, think long term.
So you made a very interesting point about part ownership. But there's a lot of chatter always about catching the market bottom. What we fail to understand is that, market bottom is only known in the hindsight. If at times few investors would have actually been successful in catching the market bottom, I am assuming it would be more by luck than by skill. And it is very, very important to address the fact that it is time in the market which is important and not the timing in the market which is important. What would be your thoughts on the same?
Very well said, Megha. It's the time that you spend with your investments that will make you a real satisfied investor in the long run. It is never, uh, timing the market in terms of going in and coming out. I was faced with this question a lot in April of this year. That's when the markets were pretty much at the bottom or close to the bottom, and it had all happened very suddenly. Now that 3 months have passed and a lot of water has flown under the bridge, a lot of us are coming to terms with the situation. A lot of us have better understanding of what the pandemic would be in terms of its impact on the economy. Economies have also opened up, so we're just now becoming a little more uh, clear about how the situation would evolve. But think about March and April, terrible times. Everybody would come back and say that, look, you call us as, you always appeal to us to remain calm. You always tell us that we should be long-term investors. But even our 5-year returns have now become negative. And actually, that set me thinking about, if this is true, then what message should I carry to all of our investors? Because quite frankly, 5 years is not a very small period of time. And if returns have become negative in 5 years, then there must be something which is making all of the common investors afraid about the long-term wealth generating ability of equities. So we did this exercise. We went all the way back to 2005, actually to the year 2000. We said we kept 2005 as the cutoff point, March 2005, which was basically precisely 15 years back from then. We calculated the 5-year SIP returns starting March 2005, which meant that we captured data starting from March 2000. So every month end, we took the 5-year SIP returns of the fund that I manage, which is UTI Equity Fund. So it's a very live exercise. So it's not abstract. It's a very live exercise of one of the funds that UTI has under its belt. March 2020, March 2005, April 2005, May 2005, and so on. We kept rolling forward 5-year SIP returns as of month end, and we came all the way to March 2020. So we had 15 years into 12, which is 180 readings. We had 180 data points of 5-year SIP returns in UTI Equity Fund. We realized that in these 180 data points, or 15 years, there were only 3 instances when 5-year SIP returns had become negative. It was December 2008, March 2009, and March 2020. These were the only 3 instances out of 180 data points that we were negative. Less than 2% of the times were we negative. Again, we were referencing and benchmarking ourselves to something which has played out less than 2% of times in the last 15 years and getting unnerved by that. Clearly, clearly getting influenced by what we were experiencing at that point in time, and drawing a narrative that, look, if 5-year returns are negative, what hope do we have to make wealth? So that was point number one. But I thought that, okay, this is an extreme case. Obviously, investors don't invest into our funds so that they want to prevent wealth erosion. They invest into us to create wealth. So let's move beyond the negative returns and let's move into, are we able to at least give them a fixed deposit kind of return? So I took a return of 5% as the cutoff. In those 15 years, 180 data points, we realized that it's only basically 9 times, 9 readings out of 180 that the returns were less than 5%. Only 9 times. So which basically meant that 5% of the time of the entire 15-year period have we been able to give returns less than 5%. But you see, again, investors don't invest into equity funds so as they can at least have a return equivalent to FDs. They want more. They at least want an expectation of a 10% return, a double-digit return, so to speak. So the next data point was, how many times in this 180 data points, 15 years, have the 5-year SIP returns been less than 10%? And that was 21 times out of 180, less than 12% of the times. 88% of the times, our 5-year SIP returns were higher than basically 10%. Now the last 2 data points, which are the most crucial, and I would really draw your attention and the attention of everybody who's listening to this. The average of this 180 data points is basically 17%. So the average 5-year SIP returns through those 15 years, and by the way, it's not just 15 years because the data goes back to 2000, because that's how 5-year SIP returns are calculated. So over a 20-year period, the average comes out to 17%. The last point which I want to drive home is exactly the short reply to your question, does timing matter? Interestingly, the last time when we saw this negative returns, like I said, was in the financial crisis. And like I said, December 2008, March 2009 was when we also saw a negative 5-year return. We looked at December 2008 returns, they were negative. Many investors would have literally, lost the discipline. Many would have stopped making SIPs. Many would have exited and so on. But for the patient investor, for the investor who realizes that, these things do happen in markets, Mr. Market will show you bouts of pessimism and optimism. For the guy who had persisted, the good news is that within 12 months, which is December 2009, the 5-year SIP return had become 21%. Can you imagine the swing? And these are SIP returns. This is not a point-to-point return. 5-year SIP return, December 2008 was negative. 5-year SIP return, December 2009 was 21%. You see, that's how situation changes so fast. And that's why we always have to look at the longer term rather than looking at shortcuts. Patience is rewarded in the markets. Like you said, it's the time that you spend in the markets that is more important, never your ability to time the market.
You made a very interesting point about persistency in the market, which an investor should have. But we often get this question, and more so recently when markets have had a little rebound, whether it makes sense to exit today and possibly buy at lower levels. Do you think there is merit in this strategy?
Not at all. Never. In my 20-year career, and you can add a few more years to that, when I was a student of finance, I have never ever seen a person who has convincingly proved to me with data that there is a scientific way, or there is a process that one has created to basically sell at a high, buy at a bottom, and again keep repeating that. It never happens. And by the way, let me in the kind of framework that I have for myself, I think it's nothing but speculation. On what basis would you tell me that selling a Maruti today is makes a lot of sense, and buying it back when the stock is down 20% again makes immense sense? There can never be a rational logic for that. Right up front, we did discuss about the price versus value equation. No matter what the intensity of any economic crisis is, and the present economic crisis is no uh, mean crisis. It's a severe crisis. But you see, the value doesn't move that much. So on what basis do we tell ourselves with data and with hard numbers and quantitative facts in front of us that selling a Maruti, which is already down 10-15%, would still make sense, and we should only cover it much later? It just reminds me of a study which Fidelity, which is one of the largest global asset managers or mutual funds, if you want to call them, is. And they did the study way back. I'm forgetting the period. The study is at least a decade or more in terms of vintage. And what they did was they basically took out data of some of their key schemes, and they looked at the long-term performance of their schemes to figure out what they have, the returns that they have created, or return that that particular scheme has created. And then they looked at their investors who've been invested into these schemes for a fairly long period of time. And then they realized that when they did this exercise, majority of the investors, and they repeated this exercise across different schemes, the conclusion of the study was that majority of their investors are not able to even capture the return which the scheme has given. And that happens because many investors, so let's say I'm an investor who's been there in that scheme for 10 years. I start my journey in 2010. Unfortunately, my returns from 2010 to 2020 don't even match the scheme returns, because whenever the markets move up, I invest more. Whenever the markets come down, I stop my investments. Sometimes I even exit partially. Then I again make my investments. And that's precisely the point that you're making. Investors feel that it makes immense sense to sell now, buy later. But you see, even if they have missed out a couple of big up moves in the market, their long-term record is going to be nowhere close to the long-term track record of the underlying scheme in which they want to invest. And that's the phenomena which gets repeated time and time again. So this is a very, very dangerous behavior showed by investors. I would totally, with all kind of sincerity, appeal that this should never ever be in the framework.
So I completely agree with you that an illusion of control is very damaging to the portfolio. But if I just step into the shoes of my investors, I think, where it comes from is an anchoring bias. So to give you an example of what's happening today, so 7,500 was the market bottom. Now, a lot of investors have exited thinking they would want to redeploy at 7,500 levels without taking cognizance of the fact that things are dynamically changing. What role do you think anchoring plays? And it is very damaging. I completely would agree to your answer. But what should one do to control it? How should we base our decisions more on factors which are dynamically changing?
Good question again, Megha. Anchoring bias is one of the most dangerous kind of behavioral traits which investors time and time again get trapped into. And you see, there are many permutations, combinations of this anchoring bias. It moves in all directions. Right now, you're talking about investors getting anchored to 7,500, thinking that, you see, the markets will once again come back to this level. Investors are basing their entire thought process around, look, the disease is still around. In fact, the disease is catching more and more people and spreading by the day. Markets seem to be oblivious about this. Markets seem to be moving in a completely different direction. We will wait for the markets to again become more rational, and rationality for them is markets coming back to 7,500. That's how they're defining rationality today. But you see, the markets basically are never driven by this. Let me just give an example to you in terms of a particular stock. And like I said, there are different instances of anchoring bias. You may have, and I keep getting asked this question by many investors. What is your selling discipline, for instance? When do you sell a stock? If the stock has gone up 2 times, 3 times, don't you think it's the right time to sell? Because if you don't sell, the stock will come down. You see, like I said, value gets created in a business when a business continues to grow, when a business continues to generate strong cash flows, and those cash flows keep growing beyond what you had estimated. And if value keeps growing in a business, the stock price also keeps moving. So one variant of the anchoring bias is that you buy something, you sell it too soon. Because if I bought it at 100, the stock is already at 500. You see, you're anchoring yourself to 100 and thinking 100 has become 500, right time to sell. This is as dangerous as somebody saying that I bought it at 100, the stock has come down to 50, I will not sell it till the time it goes back to 100 because my purchase price was 100. This is another variant. You see, the business doesn't know at what price you bought it. The business value will keep increasing along with the prospects for that business and that growth for that business and the moats that that business has created for itself. If I take the exact opposite of this, it is what you precisely mentioned, which is investors are anchoring themselves to 7,500. So we want to buy only when the value comes down to that. I don't know on what basis this 7,500 came into the picture. Why are investors anchoring themselves to that? 7,500 was nothing but a panic, a knee-jerk reaction which happened in the first 1 month when investors basically lost their minds. Possibly even you and I lost our minds and we were totally freaked out in terms of, look, what's happened? The textbook doesn't provide us an answer to how to behave right now and what's the value that we should ascribe right now to businesses. So this is a completely unforeseen event, and because of this, many investors just went out and sold their stock and wanted to run away from the market. It was a panic reaction. No buying and all selling led to things melting down and falling down like 9 pins. Now, anchoring yourself to that particular number obviously is going to be wrong. Like I said, investors keep telling me that the markets are moving in one direction, the economy shows no signs of coming back to normalcy, the disease is only spreading, hospitals are inundated. How can you ever think of, under such circumstances, the markets moving up? You see, the problem is that investors in the first place were wrong when prices came down by 30-40%. They shouldn't have come down by more than 10-15%. That's the detailed explanation that you and I had in the beginning. So the correction itself in terms of prices were overdone. That's mistake number one. Mistake number two is anchoring yourself to that and saying that the markets will have to come back again to those levels because the problem is still around. Well, the problem is still around, but the fact remains that markets are forward-looking. In the last 2-3 months, some bit of the reaction which was overdone in March has gotten corrected, but we still haven't retraced back to where the actual value lies. But because markets are forward-looking, there will be investors who would actually go back to their equation and say that yes, this has a problem in terms of impact on cash flows for a couple of years, but after a couple of years, things will go back to normalcy. If that's the case, what should the value be? And they get a reply, and in terms of that, they realize that look, prices are still significantly down compared to the value. This is how many long-term thinking investors would have already built positions in the last couple of months. And then the common man continues to wait, or the common investor continues to wait till the time the economy starts to do well. But believe you me, by the time the economy starts to do well, history will repeat itself and markets would have already made a new high. By the time all the good news will come to you and me and to all common investors, prices would not be here. Prices would have moved up significantly. So it's the old saying that what the wise man does in the beginning, the fool does in the end. And that is how in the markets you have a common investor selling at the bottom, buying at a high. You sold out at the bottom in March, you continue to sell some more in April, you are sitting out of the market today. After a couple of years, when economic data will start to look cheery and rosy, you would want to buy the markets then, by which time markets perhaps would have already made a new high. Don't ever let that happen to you. Continue thinking longer term. Yeah.
Yeah. I think you made a very interesting point that, good news and great returns will never be in sync. But what actually happens at the ground level is something what we call a resonance bias. So we would have few investors who would be in the aviation industry, some maybe in the hotel industry, a few in the startups, etc. Now, the situation they are in is obviously very difficult. The near-term outlook for these industries are also not as great. But what typically happens is that they extrapolate what is happening in their industry to all the sectors. They forget that, there is a merit of diversification and investments are about diversification and we're taking due care of it. So how would you advise someone to not just see the present, but, understand things from a longer term perspective, though you're kind of personally very badly affected, with this crisis?
Sure. So you see, I think I completely understand the situation that many people are facing right now. I have a very close friend who's a pilot with one of the airlines in India, and he's having a challenging time too. But you see, that again is a key reason to invest and invest for the long term. Why is it that we don't want to keep all our eggs in one basket? That's because we're never certain about the future. The future will continue to throw strange surprises at us. And it is for this reason that we invest for the long run, so that we create a nest egg for ourselves, which takes care of us during rainy days. So precisely for the reason that you're mentioning, which many people who are in the aviation industry are facing, many people who are in the hospitality industry who are facing, it is precisely for this reason that the importance of investing comes in. Now let me peel the onion and go further. Uh, Investment is important to take care of our rainy days. And how do we invest? We invest by way of investing into diversified funds, not taking too much of risk by investing into a single sector. I've always been saying that you can be in love with the most fashionable sector of that times. It could be a pharma, it could be the pharma sector, it could be the banking sector, it could be the auto sector. But do remember, all sectors can suddenly fall off the cliff and go past their glory. It is important to invest into a diversified fund. If you invest into a diversified fund, possibly some of us did have aviation, possibly some of us did have a hospitality or a restaurant business in our portfolio. Is it going to swing the prospects of that fund in the long term? Certainly not. These exposures could be 2, 3, 5, at best 10%. Can it change the course of the return profile of the fund in the long run? Absolutely not. In the short term, some bit of volatility, but the fund manager would also be able to course correct. So I think one needs to understand that the importance of investing and investing for the long run can be best understood by what you just explained to me. All of us in our lives are facing, a very uncertain future. Life will continue throwing curveballs at us. We would never get the answer beforehand. But what we can prepare for is basically insulating our nest egg from the kind of pulls and pressures that we face every day. And that's where the importance of a balanced, diversified portfolio comes in. So, yes, they're facing this uncertainty today, but I just want to, since your question was very, very specific, let me also give you a specific reply. While businesses and certain industries are really facing an uncertain immediate term future, and let me also again correct, aviation is going to be around possibly for 100 years. I can't think about life without aviation in the long run. I can't think about life without hotels and restaurants in the long run. They're possibly facing this problem for the next couple of years, because of which there is going to be widespread unemployment in these sectors, but they will return back. But just like they're facing this problem in the near term, there are certain other businesses which are actually going to be positively impacted in the near term itself. Think about IT businesses. Everybody. So what was known as business contingency plans, to my mind, have now become business as usual plans. What was known as your contingency plans today, all of us for the last 3 months have invoked those contingency plans, and that's how our businesses are running. Now, how are they running? They're running because of technology. And how are these technology reaching out to us? Because of different IT services companies. These businesses will have wind in their sails in the next couple of years. Of course, in the long run, they already had, but they will be disproportionately rewarded. Consumer durable companies, everybody wants to have one additional laptop. The kids in the house also need laptops today because they are going through online learning. We all want a couple of extra mobile phones in the house because that's how our lives are running. We possibly want dishwashers in the house. So you see, every crisis brings opportunity along with it. It's a sad thing that some people are facing the brunt, especially people who are in those industries. The crisis is also bringing in opportunities. And any fund manager like me who is looking at the picture in a much more holistic manner and a much more nuanced manner is also finding opportunities, by the way. So again, don't anchor yourself and reference yourself to one particular industry and extrapolate.
My next question to you is on the availability and recency bias. So what we typically see is both investors and fund managers at times do chase momentum on basis of what they hear and what the recent trends are. So to give you an example, we have seen a lot of portfolios where financials are being dropped and pharma is being added. To give an example of your fund, you have just played the opposite. How would you advise investors to possibly think long term in terms of both sectors and also while taking broader asset allocation decisions?
Well, Meka, nothing can be more ironical than this. While we always exhort our investors to think long term, tell them not to think about the short term and the here and now factors, but we possibly don't display the same kind of behavior when it comes to managing money. So if there are investors and fund managers who are basically for the short term, selling out of sectors like banking and financial services and investing more towards the relatively more defensive sectors like pharma and possibly consumer, I would say that this is just the antithesis of what we are preaching. So, you see, when it comes to the UTI equity fund, we clearly have a very, very long-term kind of thinking that's there in our framework. So we always want to look at our investments from a 3 to 5 year perspective. It's never the price movement over the next few quarters that excites us about a business. It's always the prospects of the business over the next 3 to 5 years that motivates us and excites us. And thereby, the exact opposite is that even if we know that a particular sector is going to do too well in terms of its stock prices, because it's the flavor of the season, the market loves it. But if we have picked up certain structural issues to that particular business, we would be happy to sell out. And I think that is precisely what we have done in the last 3 months as well. While investors have been saying that banking and financial services would be the worst hit sector, moratorium is something which would lead to problems. We would anyway have non-performing assets increasing for these businesses. I don't disagree with all of these things, but we have to be mindful of two things. One, are the prices already reflecting that? Which is unequivocally yes. The prices have fallen much, much more than what was. Second thing that comes to mind is that, you see, we have to look at businesses in the long run. Banking and financial services is a hugely underpenetrated industry in the country. Our debt to GDP ratio, when it comes to household debt to GDP ratios, are significantly lower than even emerging markets. In case of developed markets, these household debt to GDP numbers are many times over. So as consumption boom happens, we will witness an increase in consumer financing, whether it is auto financing, whether it is mortgages, whether it is consumer durable financing, and so on. And therefore, banks which are well managed, banks which have conducted their affairs with propriety and with discipline would continue to see strong tailwind. Of course, there will be such kind of episodes that are happening every now and then, but the longer term picture is intact, and you're getting all of that longer term structural story at a discount today. On the other hand, I should remind you that investors were basically looking at pharma sector and healthcare sector very, very negatively till about 6 months back. They were only concerned about the near-term factors. US FDA is coming knocking at the doors and shutting down plants. And that led to a lot of negative sentiment. People were not thinking about the fact that healthcare and pharmaceutical is a structural story for India. As per capita income improves, people and households will spend more on their healthcare. Beyond the roti, kapda, makan, the basic needs, people would want to spend towards their own health, their own well-being, and so on. So pharma was a structural story. That's why we were always overweight pharma. So is financials. It's just that the reversion to mean was so strong in one single month that pharma, which was one of the worst performing sectors, became the best performing sector even over a 1 year period. Forget 2 months, 3 months, even over a 1 year period, and by a huge, huge margin. Financial services, which was a best performing sector by a huge margin, became a worst performing sector. And when this happens, it's only our discipline and thinking about the longer term which tells us, yes, pharma is a core holding, and yes, financial services is also a core holding. But because of this huge price behavior, it makes immense sense to take some money out of pharma and put it into financial services, because that's where risk reward has become most favorable. So it is again the discipline, again the long-term thinking that is helping us. I would urge all investors to look at their own allocation across schemes in a similar manner. Never get influenced by what's happening in the near term. You will never ever be able to call out what's going to happen in the near term. The best example I can give to you about this is, again, these two sectors. The whole world has been talking about uh, coming out of financial services, investing into pharma, and so on. They were saying exactly the opposite pre-March. And in the last 3 months, they're now saying pharma is the best sector to be in. It's the most defensive sector. I don't know how many of us are aware that from the first week of April till today, almost 3 months, financial services sector has outperformed pharma by a huge margin already. While we are still negative, we are still thinking about the damage to the financial services in the near term, but the prices are telling us something else. Go back to what we were discussing earlier. What the wise man does in the beginning, the fool does in the end. So therefore, never get influenced by short-term factors. Keep your longer-term picture very clear in front of your mind and make your allocation basis that.
So now that I have you here, I can't let you go without your final thoughts on the market. And you did bring about a very important concept of mean reversion, which is, markets will swing in either directions, and we will not know how much damage it will do either side. But what is your general thought on mean reversion, and where do you see it given the current market scenario we are in?
So, Megha, let me just first build a backdrop to this. In order to understand mean reversion of equity markets as an asset class, mean reversion of returns concomitant to this asset class, let's first understand the broad framework. What is it that continues to excite me about equity as an asset class? It goes back to the basics of our economy. What's the lay of the land over there? The lay of the land, as I see it, is fairly simple. We will continue to be an economy which will grow between 6 to 7% as an average outcome over the long run, by which I mean over the next 10 years or the next 20 years. Now, let's not get into why I feel it's 6 to 7%. By the way, this has been the number over the last 25 years or more than that now, because the economy opened up in 1991, and the true potential of India and the true growth of the Indian economy has been witnessed only post 91. So let's say 30 years. That's been our average number. It keeps changing from year to year, and there are years of poor performance and there are years of strong performance. So my basic construct remains that we are going to be a 6 to 7% real GDP. We're going to be about 4 to 5% inflation. The long range inflation in India is higher, 6%, but I'm assuming that there have been structural factors which have been done by successive governments which would bring down the price shocks, which have helped the economy become more productive. As economies become more productive, they witness less inflation. And certainly, bouts of inflation are things which we won't hopefully witness as the economy keeps maturing. Let's work at a number of around 4.5%, 5%. So let's say 6.5%, the midpoint of our real GDP growth, 4.5% our inflation. The economy will continue to grow at 11% on a nominal basis. That's the whole economy. It's those dull and boring, stodgy, big businesses, and there are nimble-footed, early life cycle businesses which will grow faster. Hopefully, as an investment manager, we would be able to pick up these businesses which are at the early stage of their life cycle. Therefore, while the economy is growing at 11%, I do believe that our portfolio would have the ability to grow faster than this. Possibly 14-15% is what our effort is. Now, see, that's the big picture. If the portfolio of companies that we are having will grow at 14-15%, it is only obvious to assume that their share prices would also reflect that and therefore grow at 14-15%. That's the big picture. They should, if they grow at 14-15%, that's the return that our investors should expect. Now, when you talk about mean reversion and you talk about the outlook on the market, the fact is that while the portfolio earnings in the long term would be around that ballpark, their prices would never be that. It never ever has happened that while your earnings growth, the overall nominal GDP growth, and drawing from there, the earnings growth of your portfolio would be a mid-teen number, but the NAV returns of your portfolio have never been lockstep with that. Certain years plus 30%, certain years minus 10%, certain years plus 5%, never exactly in lockstep or in sync with plus 15%. So when you talk about reversion to mean, all I want to tell you and to all our investors is that, you see, wherever we approach this equation from, there will be times when the markets will be extremely euphoric, extremely ebullient, investors would be so optimistic about the future. The returns will one fine day revert back to plus 15%. And likewise, there will be times like today when there is widespread despondency, people are feeling so scared, and therefore people are so pessimistic about their future, and therefore stock prices are reflecting that, they too will revert back to plus 15%. So long as, I said, the lay of the land tells you that Indian GDP growth on a nominal basis is 11-12%, businesses will also grow at that. Earnings growth, by the way, is a nominal number. It's not a real number. So earnings will grow at that. Portfolio earnings on a cumulative basis will grow at that, and therefore stock prices will also reflect that. So yes, I do expect in the long run returns from portfolios being somewhere in the mid-teen ballpark. So that's the big picture for you.
Thank you so much, sir. I mean, this brings us to the end of questions, and it's such a vast topic that we could go on forever. But my important takeaways from our discussion today is that you should not get influenced by short-term noise. Remain a long-term investor and train your mind to think long-term. I think that is a very, very critical point that you have made. And another very important, interesting point that you have made, for which for me is a learning, is that think of yourself as part owners. That solves most of the problems in taking right decisions as far as investment decision making is concerned. Don't try to extrapolate. There will be trend changes every time there is a crisis, and don't anchor yourself to numbers which you don't understand. Thank you so much, sir, for joining in. And it's been an absolute pleasure to have you. I, on behalf of our entire team, is extremely appreciative of all the efforts you have put in terms of the number of calls you have done with me. Thank you so much for your time and for being so patient with us.
Pleasure is entirely mine, Megha. Thank you very much for this session, and I do hope that this literally helps many of our investors who would be watching this. Thank you.